Well, hi everyone. Sean Humphreys here. Welcome to All Things Retirement. Well, in this edition of the All Things Retirement video series, we're going to talk about something referred to as the fund quilt. And we'll unpack that in more detail just in a couple of moments. But really what we're talking about is the importance of being really educated. You don't have to be an expert in, everything investment planning, but there are some basic principles that we need to keep in mind when we're building our portfolios for our retirement years. Now, again, just by way of review, there's many risks that we need to be aware of when we, transition into our retirement. And the three main risks that we've talked about are inflation risk. So our retirement planning has to be structured to cope with the long-term impact of erosion of purchasing power. Longevity risk. People are living longer, and we need to build models and forecasting for retirement that cope with that. And then, of course, market risk. And market risk is even a bigger issue these days because the returns that retirees are getting on the traditional investments that they would naturally look to, government bonds, GICs, income funds, are extremely low. And so they're venturing into areas that add the short-term risk to their portfolio. So it's really important that we educate ourselves on this and that we understand these basic principles. Now, when it comes to building portfolios, it's seductive to believe that we can hire someone that can help us get bull market returns without having to go through bear markets. But I'd argue that's virtually impossible to do. What we need to do is to build diversified portfolios with targeted returns that will be successful over the short, medium, and long term as we go through retirement years. Now, part of that planning is to be realistic about our prognostication ability about which investment area to be in. And one of the reasons that pension fund managers, wealth planners, investment counsel really reinforce the notion of asset mix and having a diversified basket of assets when you build portfolios is because they recognize a pattern that I'm going to show you. And that pattern is what we refer to as the investment or return quilt. So what you see in front of you is this quilt that I'm referring to. So if we go to the quilt, if you look at the top section of the quilt, going from left to right, we go from 1997 in the quilt all the way through to, let's see here, 2016. And this quilt is divided into various categories. We've got small cap stocks, we've got large cap stock returns in the blue, we've got international stocks in the red, we've got in the orange long-term government bonds, we've got in the green T-bills, treasury bonds, and we've got in kind of the gray shaded area a diversified portfolio. Now, what you'll see here is that there's a certain level of randomness from year to year in terms of which of the investments provide the best returns over time. And you can see that the individual securities that are in the portfolio can go up and down depending on the year quite dramatically. What you can see with a diversified portfolio, however, is a little bit more consistently through the years. You can see that the individual stocks, small cap stocks, large cap stocks, individual bonds, there tends to be a weaving up and down every single year. Some years they do very well in terms of performance, that's the top end of the chart, and some years they go right to the bottom in terms of return. But you'll notice that the diversified portfolio tends to be a little more consistent year to year. Sure, it may not be at the top every year, but it's not at the bottom every year. It tends to sort of go through this more consistent return experience. Now, as you retire, this is really important to keep in mind. And the reason for that is as we're going through our accumulation years for retirement and try to boost our returns, we have time on our side. And we're not consistently drawing money from the portfolio to fund expenses. We're really in the capital accumulation mode. But once we get into retirement and we start getting involved in drawing down capital from our portfolio, it's extremely important that we take out that volatility as much as we can so we're not going through too much fluctuation in the portfolio value. Because it's a recipe for disaster in your retirement planning if you begin to transition to retirement, begin to draw income from the portfolio, but see very dramatic fluctuation in the account year by year. So keep in mind the return quilt. The return quilt is very instructive. It tells us that year by year individual asset classes can fluctuate quite dramatically. It does not usually make sense for retirees to be tactical and specialized asset classes, certainly not in the majority of their portfolio. And the diversified account mixes allow us to build that consistency so we do not put too much pressure on the portfolio if the account's going down and we're drawing a steady rate of income out of the account. Well, I hope you enjoyed this edition of the All Things Retirement video. Now, do you have a retirement coach? Are you looking for guidance on your portfolio? Well, if you want to start a conversation, don't hesitate to reach out to us. The contact information is on the video, and you can look at the show notes for this video for additional information as well. So all the best in your retirement planning.